Mswatu ingosi thula akaithathe akahambe nayo akaithathe yotenza bakuni akaithathe
You're watching the Monday edition of Market View, brought to you by Eswatini TV. I am Nautilus Tole. Glad to have you on the program. The global community is digesting the news of a preliminary agreement between the U.S. and Iran, a deal that could see the reopening of the Strait of Hormuz to be signed officially on Friday. This has triggered a sharp fall in oil prices and a reassessment of inflation and interest rate expectations around the world. Now, over the past few months, Eswatini, especially the business community, suffered the brunt of this conflict with the rise in energy costs and the disruption of supply chains. With reports of such a deal, lower energy costs could ease pressures on transport, manufacturing and household spending, while also influencing inflation, interest rates and overall business sentiment. We'll speak to CEO of Business Eswatini for their assessment of this development. But first, our business stories. Moving on to our business news, government officially listed a 4 billion rand parity bond program on the Johannesburg Stock Exchange in May of 2024. As geopolitical tensions continue to drive volatility on the Johannesburg Stock Exchange, we asked the Minister for Finance, Honourable Neil Reichenberg, what the implications are for the bonds that have already been absorbed and what this means for the prospective absorption of the new bond.
At the moment, we've gone to the market twice, more or less about 450 million first tranche, a second tranche of around 700 million. So right now we do have about between 1.2 and 1.3 billion rands floating on the Johannesburg Stock Exchange. Now, the way we took these, the way we floated our treasury bonds on the Johannesburg Stock Exchange was in a fixed price. So we made sure that we actually fixed our price when we floated them. So you can do it a few different ways, but two of the most common is you have a floating base. As inflation goes up and down, the interest that you pay goes up and down, or you fix it. So it's Eswatini, because we just wanted to play safe. They price in a bit more risk maybe, but we decided to rather fix the rate to make sure this kind of volatility doesn't have an impact. So at the moment, all the treasury bonds we've floated are fixed rates, and they don't have an impact. Now, the cost of our first two listings was slightly high. We were a little bit uncomfortable with the cost of interest on these two times that we have floated, but at the same time, what we must understand, when you do come to the market for the first time, the market does actually, because of the risk and a new player, you don't necessarily get the greatest rates. But we totally believe in time we'll be able to get those rates down and get them to a more acceptable interest rate on the Johannesburg Stock Exchange. So we'll be going back to the Johannesburg Stock Exchange soon, and we'll be seeing if we can get the rates to be more and more in line with our domestic market, as well as even in line with, similar to South Africa, rates that they float their treasury bonds on the same stock exchange. When we go to the market now again, it'll be priced based on fixed. So we'll again fix it. So which means be it a 7-year or a 5-year or a 3-year treasury bond, maybe even go up to 9-year treasury bonds, we'll see what we float, what the market is ready for. So we do a lot of market sensitization before the time to see what we feel will be able to, what is needed in the market, and we float that specific bond. But we'll definitely go fixed again, just to make sure that any volatility does not have an impact on us, that we know exactly what we're going to pay for the next few years.
The headline inflation rate for last month this year compared with the same month last year is 2.7%. This inflation rate is 0.7 percentage points higher than the 2.0% observed in April. According to the May Consumer Price Index report, the 2.7% recorded last month is 0.5 percentage points lower than the inflation rate of 3.2% observed in May last year. We are now joined by Bongmenzi Eswatini, a statistician at the Ministry of Economy, Planning and Development, to unpack what influenced these changes in the inflation. Mangweni, good afternoon. Thank you very much for joining us. So as per the report, 2.0% was realized when we're looking at the headline inflation, realized 2.0% in April and 2.7% in May. What factors really contributed to this increase?
Good afternoon, Notsile and the viewers. What we can say about the inflation going up from the 2.0 to 2.7 in May. One, we can take note of the increase in the fuel prices. Secondly, we are seeing the category of housing utilities also showed an upward trend. So based on those two, they are the main contributors to the inflation, hence the upward trend in inflation rate.
Why is it that the food and non-alcoholic beverages category recorded an annual inflation rate of 1.8% or negative 1.8% in May of 2026?
Okay, one would take note of what happened last year. So from last year, food inflation has been on a decline, and now in comparison, we are still seeing a negative increase. So now, when you try to balance and see what is the cause, so we are seeing stable prices for food items, yet they have been on a decline. So if on average the price is below, then you'll have a negative inflation rate. But if the price is above the average that you record for that particular month, then you are likely to see a positive inflation rate. So what happened here is when comparing May 2026 with May 2025, you can see that May 2025 prices were up, May 2026 prices were low. So hence the negative that we are recording.
How did inflation for goods compare to inflation for services still within 2026, and what does that really suggest about price trends in the economy?
Okay, mainly for, I'd say, when you purchase, say you are purchasing a good or you are purchasing a service. So from the data, we categorize, we weigh the goods basket as well as the services basket. So from the ways, the good basket has a higher weight and the services basket has a slightly lower weight. So in the calculation, if something drastic happens on the good side, then it pushes the inflation up. But rather, if the inflation for goods goes down, then it has the impact of making sure that the inflation is kept stable or even lower. So now, when comparing the 3.2 versus the 1.9%, we can safely say the services part, the increase for the services is lower when compared to the goods inflation. So hence you will see the imbalance as well as also when taking account into the weight of the goods and the services. Weights for goods is higher, the weights for services is lower. Hence, an impact, as I've said, in goods will lead to a much higher inflation or a lower inflation, depending on whether it's an increase or a decrease.
Looking forward, what can we expect?
Okay, I would say for the inflation rate, then what we are looking at, we are still observing the fuel prices. So we have seen that also there have been some changes even in the month of June. So we'll take that into account. As well, we'll be monitoring as we collect data from the outlets all over the country. So what we are going to do, we are going to see if is there any impact, are the prices changing or they are remaining stable. If they are remaining stable, then we are likely to see a much stable inflation. But if the prices do change, then that will mean there will be either an increase or a decrease. But now one cannot pinpoint that there is going to be an increase. It depends on how things stand, especially the fuel, because it is one of the drivers of the inflation. So if it increases or it stabilizes, then for us is to calculate whether there is an increase or a decrease and how it influences our calculations or the compilation process. But in a nutshell, what we are likely to see is if there would be an increase, then we're likely to see an increase in the inflation rate. But if there would be a stable or an even decrease in the prices for fuel, we are likely to see a much stable or even a lower inflation rate.
Mangweni, thank you very much for talking to us. That was Bongo Menzizwane, Central Statistician at the Central Statistics Office, just unpacking the May 2026 Consumer Price Index that currently records a headline inflation of 2.7%. The show continues after this. We'll speak to Business Eswatini CEO, Nathi Dlamini. Stay with us.
Attention retailers, importers, clearing agents and customs brokers. All television sets and decoders entering the Kingdom of Eswatini now require mandatory ESTVA authorization before customs clearance. No clearance without valid ESTVA import permit. Don't risk delays at the border. Submit your application 24 to 48 hours before your shipment arrives. We process complete applications in just 1 to 2 working days. Our QR-coded permits make the verification quick and easy. Always double-check your HS codes and quantities for smooth compliance. The process is simple. Step 1. Submit your completed application form. Annex A with product line items for TVs, decoders, and commercial invoice. Step 2. Eswatini TV reviews and approves. Step 3. Make payment and complete verification. Step 4. Receive your permit. Step 5. Clear customs smoothly at the border. Make sure you have all your required documents, a completed application form, Annex A detailing your product line items, commercial invoice, valid TV retailer license, and letter of authority if applicable. Our permits feature QR codes for easy border verification. For assistance, email us at license@eswatinitv.co.za or call our help desk. Apply before your shipment arrives. Ensure compliance and avoid delays. Remember, all TV sets and decoders entering the Kingdom of Eswatini must have a valid ESTVA import permit. Thank you. Act now.
Welcome back, and moving on with the program as global attention focuses on the Strait of Hormuz, a critical shipping route for the world's oil supplies. Recent developments have seen U.S. President Donald Trump announcing a preliminary agreement between the U.S. and Iran aimed at reopening the strait and easing tensions in the region. Iran actually also did confirm this agreement. Now, the developments have already influenced global oil prices and financial markets, with analysts closely watching the potential impact on trade, transport costs, and energy security. Locally, fuel prices have been on the rise since the beginning of the U.S.-Israeli-Iran war. And we're now joined by Business Eswatini Chief Executive Officer, Nathi Dlamini, to unpack what these developments could really mean for Eswatini businesses, particularly in relation to fuel costs, import prices, supply chains, and the broader economic outlook. Nkosi, good afternoon. Thank you very much for joining us. So we did see markets reacting to such news. I want to understand, what is your assessment as Business Eswatini? Do local businesses really have much reason to celebrate?
Well, first of all, thank you very much. And thank you for having me here. I'm very, very pleased. Firstly, let's just say we're hugely excited about what has just happened. That finally, at the end of the day, cool heads decided to prevail. And it seems like there is now some semblance of an agreement. And I say some semblance of it, even though it's signed, but one has to appreciate that it is still a very, very fragile agreement, which I hope it can hold for the foreseeable future. So I'm very pleased about that. That effectively means that obviously the Strait of Hormuz will open and energy fuel will start flowing at this side. What's crucial is, and I think I said it on this very same program, one of the first vessels which was detained in the Strait of Hormuz was one carrying also fuel coming into the Kingdom of Eswatini. So we're the very early victims of this. And now it having been probably opening very, very soon, it's going to change everything. You can argue the damage has already been done. You've seen inflation in this country rising, primarily owing to fuel prices and other commodities climbing up. You know that we also get fertilizer. Our fertilizer comes from the Strait of Hormuz. And as such, you've seen the prices of fertilizer skyrocketing. We didn't cause this war. But as citizens of this country and indeed as businesses, we are paying a price for it through higher input costs, firstly, and as a result, higher inflation. High inflation may then entail that interest rates will also escalate, which means more financial costs coming through our way. But we have cause to celebrate for now that this is happening, and we welcome it, and we can just pray that it will hold for some time to come. I was worried, and especially the agriculture sector of the kingdom, worried about we're going to a planting season soon. And if the Strait of Hormuz is closed and our fertilizer comes through, then what's going to happen when you start planting in September? But now that it's open, hopefully, the agricultural sector will not be as affected as badly. But yes, we'll live with the after effects and the damages of it as businesses, and indeed as New for quite some time. But now we're just celebrating.
Right, because we've seen this back and forth between the US and Iran, and should it hold, just as you're optimistic that it will, how soon then should local businesses expect some form of relief or improvement in terms of import costs and supply chain reliability?
I think, first of all, and you're right to ask me, that's why I keep on saying, because they've told us almost 38 times that a deal is happening. So now we even though we're cautiously optimistic, there is this lingering thought: is this real? But let's assume for a minute that it is real. We think it may take 3 to 6 months for things to normalize, for international supply chains to be rejigged and reconnected, that they flow properly. We are estimating about 3 to 6 months for things to normalize, including seeing the drop in oil prices. Even our fuel pumps, please don't expect them to drop in the next month or so. We are expecting that they will start dropping maybe in about 3 months' time.
3 to 6 months could be a long time, especially for the consumer, given the cost of living and the other existing economic pressures. What about for the consumer? Should this also affect them as well, given the 3 to 6 month period?
Which was it talking about?
The consumers, Nkosi, should they also expect the same results within 3 to 6 months, or we're just looking at it from the perspective that maybe only businesses are just going to benefit within the next 3 to 6 months, and then maybe we can see that trickling onto the consumer, especially at the pump?
It's a valid question, but I'm thinking, hey, it's it's going to affect everybody, including the consumers. Please still budget high prices, at least for the next 3 months, because we don't see consumers benefiting out of this. And certainly, if the input costs of businesses have not been normalized in 3 months already for them to pass those benefits onwards to the consumers, so nothing will change. I think through history, we have known that things such as this one, once they are normalized, they will always take about 3 to 6 months to come back to normalcy. For now, we just have to keep on slugging it out under this cloud of really high inflation, high cost of living. The whole world is paying for these bad decisions, to be honest with you. It's just not us here, it's across the world. And yet we as a kingdom, we did nothing to start this war.
Allow me to wrap it up, Nkosi, by this one. 104 days later, we are receiving good news, for now at least. What have been some of the lessons here? How should local businesses be preparing for a scenario where oil prices do spike again?
Unfortunately, there is, because you could argue, say you can get future contracts for this, but they are very, very, very expensive. We are a net importer of fuel. We are price takers, unfortunately. But what's encouraging is that now we are having this strategic fuel storage reserve that's coming up. And I'm thinking once completed, at least that storage will give us at least 3 months leeway. Because imagine if we had fuel in our storage that lasts for 3 months, it would have really, I believe, attenuated the effects of these price increases. But we didn't have. The fuel reserves that we have in this country right now, they average only 1.5, maximum 2 days, which means all the storages around the country for fuel, they last us for only 1.5 to 2 days. And we need a reserve that we can put fuel, strategic fuel reserves for up to 3 months at least as a minimum. Because if in the absence of that, I don't see any way one can prepare for this.
Fair enough. Nkosi, thank you very much for talking to us. That was Business Eswatini CEO Nathi Dlamini just chiming in on the interim ceasefire between the US and Iran. After this, we'll speak to in-house economist Sanele Sibia.
To all the viewers of Eswatini TV in the kingdom and beyond. Eswatini TV is regulated by the Eswatini Communications Commission through the Broadcasting Code and Broadcasting Guidelines. Under these instruments, the station commits to broadcasting information and news that have been fact-checked, programs and content in respectful language with no elements of hate speech, violence or sexual activity. If you hear any unsuitable content on this channel, you have a right to voice your complaints with the station management. Should you not be satisfied with the response or action taken, you can escalate your matter to the Communications Commission at PO Box 7811 Babani. Call 2406 7000 or send an email to info@esccom.org.za. For more information, visit www.esccom.org.za.
Welcome back. I'm moving on to our market analysis. In-house economist Anele Sibia joins us virtually. Mr. Sibia, good afternoon. Thank you very much for your time. So the trending statement is, and I quote, "Ships of the world, start your engines, let the oil flow." What do markets make of this?
Thank you, Notile. Good afternoon to you, and also good afternoon to the viewers. So I think now that is the statement that is driving markets today. And I think the only red that we are seeing on the markets today are actually the reds that we are looking at, that we're hoping to see in the longest time. We're seeing the price of Brent crude oil, just jumping down to the lower 80s. And I mean, now that's a good sign. And the fact that we are already hearing of the fact that the Strait of Hormuz is now going to be open, or if it is not yet open. So, but we are waiting to see what Friday brings. But overall, we have a very happy mood in markets. Starting in the US, the Dow Jones Industrial Average is up 353 points. The Nasdaq Composite Index is up 79 points, and the S&P 500 is up 37 points. So we're seeing the Dow Jones Industrial Average back on those record levels, sitting at the 51,000 mark. Now, that's largely driven by the fact that we are seeing, ships of the world should begin to sail right now. And now that is the sentiment that markets are carrying through. And then coming into the European markets, in London, we're seeing the FTSE 100 back up into 12.96 points. The DAX in Frankfurt is up 320 points, and the CAC 40 in Paris is up 99 points. Now we're seeing London back on the 10,400 mark. Remember, before the war, London was at 10,800, and then it came down and really just got subdued around the 10,300 mark. But now we're seeing London edging up to the 10,400, and hopefully by the time we get to Friday and we see that peace deal, we should see London back on those 10,600, going back to those pre-war levels there. And I think markets are really just happy and quite convinced with the fact that we have both Tehran and Washington confirming that indeed there is a ceasefire deal. And then coming into Asia, again, we're seeing the Japanese economy, the Japanese traders are the ones that are showing very big, huge acceptance of this news. We're seeing the Nikkei on the 69,000 mark, which is yet another record. So the Nikkei has actually hit 3 records in the last 2 weeks. We've seen just new all-time highs that are just that are being reached in the Asian markets. Now, the major driver here is the news around the reopening of the Strait of Hormuz, and also remember that the tech stocks were really relatively doing well even with the war. So all of those factors combined are contributing to that positive move. Hong Kong is up 124 points, and Shanghai is up 64 points on those sentiments. South Africa, again, is also on an upward surge, gaining some 3,081 points to sit on that 115,000 mark. So we're hopeful that as we get to Friday, we are going to see South Africa back on that 120,000 mark. Eswatini remains relatively stable. And when we come into the commodities, gold is up 119 points, and then oil is down 4.34 points, sitting at $82.99 per barrel. And then in terms of our currencies, the Lilangeni is stronger today, sitting at 6.18 against the dollar and 18.79 against the euro and 9.90 against the Japanese yen. Just we're showing the reds there because we've been at a much stronger position earlier on in the day just to set on this level today. So we are seeing a return to those 15 levels, hopefully as we get a clearer news in terms of what is happening regarding the war. Thank you, Notile.
Thank you very much, Mr. Spear. That was in-house economist Anele Sibia coming through with Market Insights this Monday. Otherwise, this has been the first edition of Market View for the week. Let's meet again next time. Take care.